Hi, how are you? It's great to have you on board. Welcome to the Study of Agriculture Insurance by Captive Institute. At the end of this course, you will acquire a certified certificate after covering the following. 1. The place and role of agriculture in national development. 2. Risks faced by farmers and mitigation measures. 3. Risk assessment, underwriting and rating considerations. 4. Indemnity products including livestock, crop, greenhouse, and forestry insurance. 5. Index-based insurance operations, claims processing and management, successes and challenges. 6. The place of government and other partnerships in agriculture insurance. And finally, the global practices and trends in agriculture insurance. In considering the place and role of agriculture in national development, the following are the key considerations. Contribution to national income, source of food and fiber, raw materials, export earnings, employment, and infrastructure development, such as roads, market yards, storage facilities, and transportation. Also, it reduces inequality, discontent, and helps in the expansion of democracy and purchasing power, eliminates economic recession, and is a source of foreign exchange for the country. Even with all these good contributions, farmers face a variety of risks and take mitigation measures. Risk is the probability of the occurrence of hazards or a chance of loss. In agriculture insurance, risk is an occurrence that negatively impacts agricultural production, trade, markets, and consumption. Insurance for agriculture follows the same structure and processes but different approaches. Underwriting is the process of assessing risk and making a decision on acceptance or otherwise by the company. Underwriters must determine what information is required to adequately estimate the risk exposure to be able to cater for it in pricing, including commissions by intermediaries and taxes and administrative costs. In livestock insurance, the following factors are important: the physical and health condition of the animal and the existing management by the insured, the age, identification marks, breed, species, sex, health status, and value. All this is contained in the inspection report from a qualified veterinarian. The premium rate ranges between 3.5% and 5% of the total value. The cover is for mortality. Coverage extensions such as calving, furrowing risks, loss of income, etc. attract a loading between 10% and 20%. In underwriting crop enterprises, factors such as geographical location of the farm, farming type, acreage, experience of the insured in number of years on the farm, yield production over a number of years or seasons, qualifications of farm manager if it's a large-scale or commercial farming enterprise, good agriculture practices in place or being implemented, common perils or risks faced by the farming enterprise from climate change and environmental and social aspects, target market for the yields by the insured, value or sum insured for the enterprise when it comes to crop enterprises. Premium rates are determined by the actual production history as well as past loss experiences, and the insured approaches to insurance as a risk management tool, not as a profit-making avenue or cover-up for operational inefficiency. The main risks in the practice of agriculture may be classified into the following. 1. Production risks, which are external factors, are the most pronounced. They inhibit a farmer from attaining a production level that commensurate with his input. 2. On the price or market risks. These are risks related to changes in the prices of output or inputs which occur when the farmer has already committed to production. 3. Regarding the financial and credit risks. These are risks related to lack of access to finance from financial institutions' interest rates and loan default risk in case of crop or agriculture production failure. 4. When it comes to institutional risks, these are risks associated with changes by the government on rules and policies on restrictions on the movement of agricultural produce, policies on the import of agricultural produce, irrigation, taxes on inputs and finished products, as well as taxes by different local governments, as well as fixing prices. 5. Technology or information risks also exist. This refers to the risks associated with the inability of farmers to apply modern technological advancements in farming to lower production costs or apply smart agriculture, ending up with rudimental farming that lacks sufficient innovations. And finally, we have personal risks. These are risks associated with the framer's household members or workers. They include disease and illness, injury, old age, and disability, which affect their farming operations. Others are theft, malicious damage, and accidental loss or damage of assets and personal properties dear to the farmer. In general, farmers have devised risk management strategies, which are ex ante, meaning handled before the occurrence of the risk, ex post, meaning handled after the occurrence of the risk. These strategies are either informal, that is, not organized in any particular way, or formal, referring to fairly organized approaches. Ex ante informal strategies examples include the following. 1. Seasonal migration for pastoralists in response to occurrences of conflicts, diseases outbreaks, and recurrent droughts. 2. Risk avoidance by keeping away from an agriculture enterprise that exposes farmers to the risk. Informal strategies, ex post, are the income-soothing mechanisms after the occurrence of the event that do not follow any particular rules or conventions. They include enhancing liquidity, reducing consumption patterns, the sale of assets, relocation, and mutual aid, such as borrowing from relatives. Formal risk management mechanisms are mitigation strategies that are government-aided and supported and approach the issues from a more formal and organized position. These include extension services, government subsidies on farm input, crop and livestock insurance, agro-other advisory services, commodity price support incentives, contract farming, and formal agriculture insurance products from private insurers, among other arrangements. The term indemnity insurance can be simplified as an insurance cover that compensates an insured party for the actual damages or losses suffered by the insured in monetary terms due to insured risks. Indemnity insurance consists of an indirect or direct assessment by a loss adjuster who estimates the financial costs of a loss. Livestock insurance indemnifies the insured for the death of the insured animals during the period of insurance at the location as specified in the insurance policy schedule due to an accident, illness, and diseases, epidemics, and emergency slaughter on grounds of necessity on the advice of a qualified veterinary surgeon. The age limit is 91 days to a number of years depending on the animal. The key considerations for livestock insurance include 1. Scope of cover. 2. Documentation. 3. Declarations. 4. Communication and feedback. 5. Event notification. 6. Claim reporting. 7. Positive identification of the carcass before disposal, and finally salvage value if any. The cover can be extended by loading to cover calving, furrowing and foaling risks at 10%, theft at 20%, transit risk at 10%, and loss of income is on request. Greenhouse insurance covers damage caused by the following events. 1. Storms, including hail or weight of snow. 2. Excessive rain causing sudden flooding out or flow out of gutters and drainage systems in a short time span. 3. Lightning. 4. Accidental damage from a motorized vehicle or object under propulsion. 5. Theft and or loss during fire, firefighting, or salvaging. 6. Damage from water overflow from reservoirs or water tanks owned by the insured from artificial reservoirs or water tanks used for crop production water. Being a sectionalized cover, Section 1 covers plastic cladding and steel structures. Section 2 covers greenhouse crops. Section 3, transit risks. Section 4, machinery breakdown. Section 5, deterioration of stock. Section 6, irrigation equipment. And finally, Section 7 covers other assets. Please note Sections 2 and 6 must be taken in conjunction with Section 1, while Section 5 must be taken in conjunction with Section 4. Multiperil crop insurance covers cereals, legumes, and other perennials against physical loss or damage caused by drought, uncontrollable pests and diseases, storms, flooding, and malicious damage, among other perils. The scope can be extended to cover the loss of harvested yield stored temporarily and the transit risks to a recognized destination. The sum insured is based on production costs or the pre-agreed nominated value of a unit yield, such as bags or kilos per unit area, either per hectare or an acre, as determined by the insurer's calculation of the average yield for the farmer's actual production history over a number of seasons. Multiperil crop insurance pays for the yield shortfall below the guaranteed level resulting from physical loss of or damage to growing crops directly caused by the listed perils. The benefits of indemnity insurance are as follows. 1. Guarantees return on producer's investment should any of the insured events occur. 2. Improves sustainability of agriculture production by enhancing access to credit for input. 3. Financiers easily offer loans to insured enterprises since loan default risk are reduced. 4. Agriculture insurance helps restore loss of income. 5. The need for liquid cash and emergency borrowing in case of a loss is reduced. 6. Agriculture insurance provides peace of mind. Parametric insurance, otherwise referred to as index-based insurance, is an approach that assesses losses using an indicator or a proxies such as temperature, precipitation, or average yield output of a selected area. Compensation from index insurance products is derived from deviations in the underlying index that have a correlation with insured risks such as droughts, floods, productivity, etc. There are three popular index insurance for agriculture. 1. Area Yield Index Insurance, whose terms of insurance are based on productivity yield index, in which, when an insurance event occurs, the insurer payout is based on the actual productivity reduction in a demarcated unit area of insurance. 2. Weather Index Insurance. In this type of insurance, when an event occurs, the payout is based on deviation from a weather index parameter such as rain, wind, drought, flood, cold, hail, frost, earthquake, tsunami, etc. 3. Satellite or Remote Sensing Index Insurance. This is a type of weather index based on weather parameters from satellite data, such as the Normalized Differential Vegetation Index. There are a number of advantages of index-based insurance, which include 1. Adverse selection and moral hazard are minimized. 2. Administrative costs are reduced. 3. The product is highly customized with many parameters selected by the policyholder, including the premium amount. There is a high level of structuring flexibility. 4. Payout can be very flexible and used as budget support with few or no restrictions. And finally, the timeline of payouts is very short. There are challenges in all index insurance. 1. Basis risk, which is a major limitation of index coverage. It occurs when the measured indicators do not match the actual losses suffered by the insured. It is when there are losses on the covered sectors, but the index does not reach the level of for payout or vice versa. 2. Lack of high-quality weather and yield data. 3. In most developing countries, there is not an enabling environment for index insurance, such as poor weather measuring infrastructure and technology to access and interpret to usable format.
Agriculture insurance programs are best developed and delivered in a public-private partnership, where the government creates enabling conditions, including the support of the administration and premium payment support. In turn, insurance companies, with their privately arranged partnerships, focus on service delivery, including insurance product development and paying claims to insured beneficiaries. Government plays an essential role in the agriculture insurance industry. In fact, there are very few successful agriculture programs that do not involve the government in some way. The following are the considered role of government in agriculture insurance. 1. Is premium subsidies, which are one of the most observable and common ways in which the government supports agriculture insurance. 2. Is by incentivizing production in the form of a guaranteed minimum return as a food security risk mitigation measure in the agriculture sector for important commodities for the country. 3. Is through the insurance regulator or supervisor, charged with the responsibility of supervising, regulating, and developing the insurance industry in the country. Here, the biggest role of the regulator is policy development and supervision through an optimum regulatory framework touching on products approval guidelines, technical support in training agriculture insurance professionals, education through public engagement on the importance of agriculture insurance to producers and value chain actors, and consumer protection, among others. Finally, other government involvements include product research and development, providing extension services, developing appropriate agricultural insurance legislation, implementing public sector reinsurance, taking measures to strengthen people's resilience to drought, and improving monitoring and response to drought.
Agriculture, producers face a variety of risks that contribute to income volatility, food insecurity, and a reluctance to invest in new technologies and agricultural practices. With a $30 billion global market in 2019, agricultural insurance plays a key role in finance and contributes to climate change adaptation to achieve Sustainable Development Goals, SDGs, such as poverty eradication, hunger eradication, and climate action. Some global practices and trends in agriculture insurance are emerging from the successes and challenges encountered in the agriculture sector's risk management. Though not exhaustive, the following are the top 10 trends and practices. Regarding influencing trends, the public sector has an active role in supporting agricultural insurance. 1. Governments play a vital role in coordinating public and private sector investments in collecting, auditing, and managing insurance quality data, and in making sure that the data is available for private insurers. 2. The rise and adoption of agriculture insurance and the increase in need for loss protection in agriculture businesses as well as enhanced education and awareness on the benefits of agriculture insurance to buyers, are major factors boosting the growth of the agriculture insurance market. 3. According to the GIZ report, index insurance is the most common type of agricultural insurance, a sign that this relatively new type of insurance has become the dominant alternative to traditional indemnity insurance. 4. More than half of all agriculture insurance is internationally reinsured due to a high level of private sector involvement. 5. Drought and flood are the most common risks sought for agriculture insurance. 6. Digital technologies are helping to improve agriculture insurance contracts, strengthen security and distribution channels, and speed up claim payments. 7. Public-private partnerships are the way to go for agriculture insurance in the future, especially for developing countries. 8. Subsidizing insurance should be made in various ways in agricultural insurance systems to encourage widespread uptake. 9. Subsidized agricultural insurance contracts for farmers are quickly replacing traditional post-disaster relief or assistance due to fast, prearranged, ex-ante, and guaranteed payouts. 10. Coinsurance arrangements, otherwise referred to as agriculture insurance consortiums, in partnership with public and non-government organizations, are proven effective in agriculture insurance schemes. 11. In more than 50% countries across the world, agricultural insurance is provided exclusively by the private sector, most commonly private limited companies, but also by private mutual, cooperative, and microfinance institution insurers. 12. The global agricultural insurance market is segmented on the basis of coverage, distribution channel, and region. 13. The United States Federal Crop Insurance Program is the largest in the world, covering over 85% of planted acres of grain crops. The government heavily invests in communicating the terms of insurance with well-structured sales windows and provides subsidies for farmers in the USA.
When setting up an agriculture insurance portfolio, consider an approach mirroring the setup of your Ministry of Agriculture. 1. Identify the Ministry of Agriculture enterprises of key importance by researching the policies and initiatives of the farmers, cooperatives, and associated value chains. This research will help you understand the agricultural landscape and the potential opportunities for risk and insurance. 2. Identify the areas of risk. Once you have identified the key stakeholders and their activities, you can then identify the areas of risk associated with the agricultural sector. These could include weather-related risks, production and supply chain risks, and market risks. 3. Once you have identified the areas of risk, you can develop an agricultural insurance portfolio to cover these risks. This could involve developing general liability policies for farmers, crop insurance policies, and livestock insurance policies. 4. Design the product. You will need to design the product to ensure it meets the needs of the agricultural sector and is feasible for your company to offer. This could include determining the coverage limits, premiums, and other product features. 5. Promote and market the product. Once the product has been designed, you will need to promote and market it to potential customers. This could involve advertising campaigns, discounts, and other incentives. You can also work with the Ministry of Agriculture and other key stakeholders to ensure the product is widely available. Under the crop insurance line, you can have greenhouse insurance, multi-peril crop insurance, forestry insurance, weather index insurance, and area yield index insurance. Greenhouse insurance. This insurance covers damage to greenhouses and related structures, as well as crops, from events like fire, vandalism, lightning, hail, wind, and other weather-related events. Multi-peril crop insurance. This type of insurance provides protection from losses due to natural causes, such as drought, hail, excessive heat, and frost. It also covers losses from other causes, such as insects, disease, and wildlife. Forestry insurance. This type of insurance covers damage caused to trees and timber from events like fire, lightning, hail, wind, and other weather-related events. Weather index insurance. This insurance covers losses due to deviations from the expected weather conditions. It is typically based on the historical weather data for the area and can be used to protect against weather-related losses. Area yield index insurance. This type of insurance provides protection against losses due to deviations from historical yield averages. It is typically based on the historical yield data for the area and can be used to protect against crop yield-related losses. Under the livestock insurance line, you can set single animal livestock insurance and index-based livestock insurance. Single animal livestock insurance protects individual animals from death or disability due to disease, accidents, natural disasters, and other causes. The insurance covers a wide range of animals, including cattle, horses, sheep, goats, and pigs. Index-based livestock insurance is designed to protect pastoral communities in arid and semi-arid areas from catastrophic losses. You have completed this audio-video training. Thank you for your time and see the next slide for your next move.
Captive Institute is an accredited institution by relevant authorities in Kenya to engage in skills development and to associate in partnership or collaborate with any other body or organization in Kenya and globally. We are dedicated to promoting and disseminating knowledge to global stakeholders to facilitate the development capacity that is not only more practical but also significantly impacts millions of lives in the world. The following are the highlights of what you have learned about agriculture insurance in this course. 1. Agriculture has a significant place and role in national development. 2. Farmers, producers, and value chain actors are faced with risks, but there are mitigation measures available both at ex post, meaning after the event has occurred, and ex ante, that is, before the event occurred. This can be either formal or informal. 3. Formal risk transfer mechanisms for agriculture risks include livestock, crop, greenhouse, and forestry insurance products, among others. 4. Agriculture insurance follows a structured approach in risk assessment, underwriting, and rating with a lot of fieldwork, which is expensive for insurance companies. The extra cost of fieldwork and administration is affecting the scaling of various agriculture insurance schemes. 5. Index-based insurance is a promising approach to addressing agriculture risks. Index insurance is technical in design and operation and simple in claim processing and management. However, there are many successes that outweigh the challenges. 6. In modern days, governments and other partners championing agriculture risk management have a significant place and role to play in agriculture insurance. 7. Global practices and trends in agriculture insurance are evolving, and agriculture risk management is poised to be a multimillion-dollar enterprise globally. As an institution, Captive Institute's final thoughts and quotes are from Honorable Pat Roberts, U.S. Senator from the state of Kansas, Chairman, U.S. Committee on Agriculture, Nutrition and Forestry, on December 2, 2015, he said, and we quote, "There is no issue in global security more timely or more relevant than food security. Show me a nation that cannot feed itself, and I will show you a nation that is in chaos." We encourage you to visit the Captive Institute webpage to register for this course and others to learn and print your certificate. On the same website, like, subscribe, share, and follow us on Twitter handle Institute Captive, YouTube channel Captive Institute, and Facebook or X page Captive Trainers to explore and get notified on other important courses on climate change and sustainability. You can also reach us by email at info@captiveinstitute.com to support this noble course either by partnership with us or by donation.